The SpaceX S1 just hit the wire. This is the prospectus the entire market has been waiting on for a decade. And there is a lot buried in it. Dual-class shares, a $20 billion bridge loan, a jury waiver, and revenue that does not come from where most people think it does. Let's go straight to the numbers. Start with the cash flow statement. Always start with cash flow. SpaceX reports $9 billion in free cash flow, and that is negative $9 billion. Net cash from operations, minus capital expenditure on plant, property and equipment, equals minus $9 billion. And this is just the first 3 months of fiscal 2026. That works out to $3 billion burned in January, $3 billion burned in February, $3 billion burned in March. For context, the same line last year was negative $3.3 billion for a comparable period. Cash burn has more than doubled. The question is where it is going. And the answer is almost certainly the same word everyone in tech is saying right now: AI. SpaceX absorbed ZAY in February. The filing does not perfectly isolate how much of the burn is ZAY-related, but the timing is impossible to ignore. Data centers, server racks, GPUs. That kind of capex shows up exactly the way this filing shows it up. Stock-based compensation tells the same story. SBC has roughly tripled year over year. Net loss last year was around $500 million. Already a sign the business was edging toward profitability. This year that loss is $4.2 billion. They are spending harder, not lighter. Now, losing money is not automatically a red flag. Uber lost money for years and figured it out. But Rivian went public losing money and the stock is down from 179 to about 13. Roblox keeps trying to rebound and keeps sliding back. The market eventually wants a return. The Elon premium gives SpaceX more rope than most. But rope is not a strategy. Let's look at where the revenue actually comes from. Because this is the part that surprises people. Total revenue for the quarter is $4.7 billion. Inside that number, Space Launch Services, the thing the company is literally named after, is $619 million. That is 13.1% of the business. Starlink, connectivity for homes, RVs, cars, planes, ships, is $3.257 billion. That is roughly 69% of revenue. Starlink is the company. Launch is the platform that makes Starlink possible. AI revenue, the ZAY piece, is $818 million, 17.4% of the top line, and almost certainly the source of most of that $9 billion cash burn. That AI segment is where the strategic picture gets interesting. SpaceX cut a deal with Cursor designed to help Grok catch up in coding, where it has fallen behind Gemini and Anthropic. Grok is also trailing ChatGPT on basic user metrics. And while all this is happening, Andrej Karpathy, the most recognizable AI researcher to come out of Tesla, was just picked up by Anthropic. That is a meaningful brand transfer ahead of Anthropic's own IPO. Speaking of Anthropic, and this matters for SpaceX, Anthropic just reported its first operating profit quarter. The Wall Street Journal pegged it at just over $500 million in operating profit, with revenue on track to more than double to roughly $10.9 billion for the second quarter. That is an annualized run rate north of $45 billion. Operating profit is not bottom-line profit. Interest and other costs still take their bite. But for a company valued near $1 trillion, declaring operating profitability is a massive milestone. Good for Anthropic, good for the AI ecosystem, and specifically good for SpaceX, because Anthropic is a customer. The S1 confirms it. SpaceX has a cloud services agreement with Anthropic that is expected to pay roughly $1.25 billion per month through May 2029, with capacity ramping at a lower fee in May and June of 2026. $1.25 billion a month does not erase a $3 billion a month burn, but it puts a real dent in it, which brings us to the debt picture. And this is the line that probably forces the IPO timing. SpaceX has a $20 billion bridge loan that expires in September 2027. Current debt sits at $17.2 billion. Cash and marketable securities sit at $23.6 billion. Net that out and you get under $6 billion of true free cash on the balance sheet. $6 billion does not cover a $20 billion bridge. Add $4 billion plus in annual losses. And the math says they need public market capital. They need to IPO to refinance. There is also $7.9 billion of related party debt, likely tied to a sale and leaseback structure, possibly connected to ZAY infrastructure. The filing leaves that thread to be pulled later. Gross margin is 50.8%, up from 48.2%. Pricing power is improving. That is a real positive. But scale comparison is brutal. SpaceX did $4.7 billion in a quarter, $18.8 billion annualized. Nvidia is projected to do $92 billion in a single quarter. Nvidia generates roughly 5 times SpaceX's revenue in one quarter the time. Call it 20 times the revenue throughput. And Nvidia is currently valued at about $5.2 trillion. SpaceX is widely expected to come in around $2 trillion. So Nvidia trades at roughly 2.5 times the market cap of SpaceX while producing 20 times the revenue. That is the price of the Elon premium and the Starlink growth story baked in. Operating expenses are growing fast. SG&A is up 51%, much of that likely IPO-related fees. R&D is $3.5 billion. Net loss is $4.9 billion. Restructuring charges hit nearly $500 million in 2024 and again in 2025. The Zay integration is producing real headcount actions. Reports indicate around 80 top developers have left, including roughly 12 of the founding-level engineers. Now the governance section. And this is where every retail buyer needs to slow down. Dual-class shares. Class A common stock for the public. Class B common stock with 10-to-1 voting power for Elon Musk. There is no sunset clause. This structure does not expire. There is no independent compensation committee, which means executive pay is not gated by an outside board. Musk will hold combined voting power of approximately 85%. He owns 12.3% of Class A and 93.6% of Class B. After the IPO he will be CEO, CTO, and chairman of the board. And then the rights waivers. No jury trial. No class action. Mandatory arbitration. Dual listing on NASDAQ Texas and NASDAQ New York. Enforceability is to be determined. Other flags. Terafab JV early stage. 20% of revenue from federal agencies. Grok Image Gen investigations. Zoom out. SpaceX. OpenAI. Anthropic. Cerebras. The IPO calendar is the most important in a decade. Watch the Canaries. Read the filings. That is your UFSM update.